Everyone wants to build wealth, but not everyone wants to spend hours every week studying charts, reading news, and managing trades. And honestly, you don't have to. Because some of the most successful investors in the world use a strategy that takes almost no effort to manage. It is called the lazy portfolio. Now, don't let the word lazy fool you. This isn't about being careless or uninformed. It's about building a system so simple and effective that it quietly makes you rich while you live your life. No stress. No constant market watching. Just steady, reliable growth. So in this video, we are going to break down exactly how to build a lazy portfolio that actually wins. One that grows with the market, survives inflation, and beats most active traders without you lifting a finger. Let's start with the basics. What exactly is a lazy portfolio? A lazy portfolio is a long-term investment strategy designed to be simple, diversified, and low maintenance. Instead of picking individual stocks or timing the market, you invest in a few broad-based index funds or exchange-traded funds that represent different parts of the global economy. Then you leave them alone. That's it. You invest regularly, rebalance occasionally, and let compound growth do the heavy lifting. The core philosophy is this: you don't need to beat the market to build wealth. You just need to be in the market consistently for a long time. Think about it this way. Every time you try to outsmart the market, you risk making emotional decisions. You buy high when everyone's excited and sell low when everyone's scared. But a lazy portfolio removes emotion completely. It's automated, disciplined, and backed by decades of research. Let's talk about why this works so well. First, the data. Studies show that over 90% of active fund managers underperform the market over 15 years. That means most people who spend their lives picking stocks and analyzing data end up losing to simple index funds. Why? Because the market already prices in most available information, and short-term moves are mostly random. So instead of trying to predict what happens next, the lazy portfolio strategy says own everything. Own the entire market. Let capitalism and global growth work for you. The lazy portfolio also saves you time and money. You don't need constant research or expensive management fees. You just set it up once and rebalance maybe once or twice a year. That's why it's called lazy, because it's low effort, not low performance. Now let's build your lazy portfolio step by step. The foundation of any portfolio is diversification. You want exposure to different asset classes so that when one goes down, another balances it out. The three main building blocks are stocks, bonds, and sometimes real estate or cash equivalents. Let's start with stocks. Stocks are your growth engine. Over time, they produce the highest returns compared to any other asset class. When you invest in a stock index fund, like the S&P 500, you're buying small pieces of 500 of the biggest U.S. companies. When those companies grow, you grow. A common lazy portfolio might allocate around 60% to 70% of your money in stock index funds. For example, 50% in a total United States stock market fund and 20% in an international stock fund. This gives you exposure to companies all over the world: tech, healthcare, energy, finance, and more. The second part of your portfolio is bonds. Bonds act as the stabilizer. They don't grow as fast as stocks, but they protect you during downturns. When markets crash, bonds often rise. So they balance your portfolio and keep your emotions in check. For most investors, 20% to 40% in bonds is a smart range. You can choose something like a total bond market fund or a short-term treasury ETF. If you want even more stability, you can add a small portion to cash or money market funds. These won't grow much, but they give you flexibility for emergencies or new opportunities. So here's what a simple lazy portfolio might look like. 60% total U.S. stock market index fund. 20% international stock index fund. 20% total bond market fund. That's it. 3 funds. Globally diversified, low cost, and proven to outperform most complex portfolios over time. But there are variations depending on your risk tolerance. If you're young and want more growth, you could go 80% stocks and 20% bonds. If you're closer to retirement, you might flip that to 40% stocks and 60% bonds. The beauty of the lazy portfolio is that it adapts to your life stage. Now, let's talk about one of the most famous examples, the three-fund portfolio. It was popularized by the Bogleheads community, named after John Bogle, the founder of Vanguard. It includes a total U.S. stock market fund, a total international stock market fund, a total U.S. bond market fund. This combination gives you exposure to virtually every investable company and bond on Earth. Simple, powerful, and incredibly efficient. Another popular option is the all-weather portfolio, created by Ray Dalio. This one's designed to perform well in all economic conditions: growth, recession, inflation, or deflation. It typically looks like this: 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. It is more defensive, great for investors who want lower volatility and steady returns no matter what the market does. There's also the lazy 60/40 portfolio, which simply splits 60% stocks and 40% bonds. It's a timeless classic used by pension funds and endowments for decades. Not too risky, not too conservative, just balanced. But no matter which version you choose, the key ingredients are the same: low fees, broad diversification, and long-term consistency. Now, one of the secrets behind a winning lazy portfolio is rebalancing. Over time, your asset allocation will drift as markets move. For example, if stocks soar, your portfolio might shift from 60/40 to 70/30. That means you are taking on more risk than you intended. So once or twice a year, you simply rebalance, sell a bit of what went up and buy a bit of what went down. This keeps your risk level consistent and helps you buy low, sell high automatically. Rebalancing takes less than 15 minutes a year. But it can boost your returns and protect you during volatile markets. Now, let's talk about cost. The number one silent killer of investment returns is fees. High management fees eat away at your profits year after year. That's why lazy portfolios use low-cost index funds or exchange-traded funds, with expense ratios as low as 0.03%. Compare that to actively managed funds that charge 1% or more, and you will see why passive investors win. Warren Buffett himself has said that most investors would be better off putting 90% of their money in a low-cost S&P 500 index fund and 10% in short-term bonds. And guess what? That's basically a lazy portfolio too. The beauty of this approach is how it frees your time and your mind. You're not checking the market every day or reacting to news headlines. You're living your life, while your investments quietly grow behind the scenes. It is financial peace of mind. Let's do a quick example. Suppose you invest $500 a month into a simple three-fund lazy portfolio that earns an average of 7% a year. After 30 years, that turns into over $600,000. And all you did was set up an automatic transfer and check in once a year. That's the power of compound growth combined with consistency. Now, let's talk about what not to do. Don't tinker with your portfolio every week. The more you trade, the worse your returns usually get. Don't chase hot sectors or the latest trends. And don't panic when the market drops. It always recovers over time. Lazy investing works because it is emotion-proof. You follow the system, not your feelings. Also, do not ignore taxes. If you're in the United States, use tax-advantaged accounts like a 401k, IRA, or Roth IRA. That way, your lazy portfolio grows faster by avoiding unnecessary tax drag. Now, some people worry that a lazy portfolio is too boring. It doesn't have the excitement of stock picking or crypto trading. But here's the truth. Boring makes you rich. Exciting makes you broke. The less you do, the more you earn, because the system compounds quietly in the background. You can still have a small fun money account if you love picking stocks. Put 5% of your portfolio there. But keep the other 95% safe and steady in your lazy system. That way, you get this best of both worlds, discipline and excitement. Now, let's address one common question. What if the market crashes? Won't a lazy portfolio lose money too? Yes, temporarily. But remember, you are not investing for months. You are investing for decades. Markets always recover because businesses keep innovating, growing, and creating value. And because you own the whole market, you benefit from that rebound every time. In fact, downturns are your best friend. They let you buy more shares at cheaper prices. If you stick with your plan, reinvest dividends, and keep investing regularly, the lazy portfolio will outperform emotional traders almost every single time. And the data proves it. From 1990 to today, a simple three-fund lazy portfolio has beaten most mutual funds, hedge funds, and even professional investors. Because it's consistent, it compounds quietly, and it never lets emotions get in the way. So, how do you start? Step 1. Open an investment account. It can be with Vanguard, Fidelity, Schwab, or any reputable broker that offers index funds and exchange-traded funds. Step 2. Choose your 3 or 4 funds based on your risk tolerance. For example, VTI, Total US, Stock Market ETF, VXUS, Total International Stock Market ETF, BND, Total Bond Market ETF. Step 3. Set up automatic monthly contributions. You can start with any amount, even $100. The key is consistency. Step 4. Rebalance once a year. And that's it. You're done. Your lazy portfolio is now working for you 24/7. The truth is, wealth doesn't come from doing more, it comes from doing less, but doing it right. Lazy investing is about patience, simplicity, and discipline. It's not about beating others, it's about beating time. Because the sooner you start, the longer compounding can work its magic. In 10 years, you'll look back and thank yourself for starting. In 20 years, you'll wonder why you ever tried anything else. And in 30 years, you'll realize that doing less was the smartest move you ever made. So if you want to invest smarter, not harder, build a lazy portfolio. Own the market. Stay consistent. And let time do the rest. Because the best investors aren't the busiest, they're the calmest. And their portfolios quietly win while the rest of the world chases noise.